Ever notice how some people seems calm no matter what the market is doing? The rates goes up, stocks drop, headlines scream recession, and they just stay fine. Not stressed, not scrambling, just steady. That's not luck. That's diversification. When your money is spread across different assets, stocks, bonds, real estate, maybe even some alternatives, one rough patch doesn't throw everything off balance. Because when your whole financial life depends on a single asset class, one bad quarter can shake everything you've built. Diversification doesn't make you immune to market swings, but it does make you resilient. And in the long run, resilience is what keeps you moving forward when others are panicking. Think back to the last few years. It's been a wild ride, hasn't it? There were folks who went all in on crypto. One week, they were paper millionaires, posting screenshots of their portfolios. And the next week, it's gone. Vanished as fast as the charts fell. Others poured everything into real estate, riding the wave until interest rates spiked and the cash flow dried up overnight. Even the people who thought they were playing it safe with index funds and retirement accounts watched their balances tumble 20 or 30% in what felt like a blink. But then there's a quieter group, the steady ones. They don't panic. They didn't make rush moves or sell in fear. Why? Because they weren't depending on just one thing. They had real estate, sure, but they also held notes that paid them monthly, maybe a few dividend stocks, quietly compounding in the background, maybe a private lending deal or two on the side. The income didn't come from one direction, it came from several. So when one stream slowed to a trickle, the others kept flowing. That's the real secret. It's not timing the market or chasing the next big thing. It's building a portfolio that keeps working even when the world feels unpredictable. That's how you create stability, not just in your finances, but in your peace of mind. Here's the thing. A lot of people think diversification just means own a bunch of stuff. A few stocks here, some real estate there, maybe a little crypto on the side, and boom, I'm diversified. Except that's not really how it works. If everything you own moves in the same direction, up when the market ups, or down when it's down, that's not diversification. That's just expensive clustering. It feels like variety, but it's all still tied to the same rhythm. Real diversification is different. It's when your assets don't all dance to the same tune. They play different roles, they move on different cycles, and protect each other when things get rough. Think of your portfolio like a table. If that table only has one leg, say real estate, it might look solid when everything is good. But the moment that one leg wobbles, the whole thing shakes. Now imagine that the same table with 3 or 4, maybe 5 legs, a mix of notes, rentals, stocks, and a bit of cash tucked away. Even if one leg gets a little weak, the table still stands strong. That's what a healthy portfolio feels like. Balance, steady, not at the mercy of one market. Let's bring it down to earth for a second. Maybe you've got a rental property that's sitting vacant. That's frustrating, right? But if you've also got a few notes paying you every month, some dividend stocks kicking out quarterly dividend, and the cash reserve ready for opportunities, suddenly you're not stressed. You've got options. You've got flexibility. That's the beauty of multiple income streams. When one slows down, the others quietly keep things moving. You don't have to panic sell or wait for the right time. You're covered. Here's why this matters so much. Real estate is amazing for long-term growth and tax benefits, but it's not liquid. You can't just sell a property tomorrow if you need the cash. Notes, though, they're steady, predictable. They pay you every single month because you've stepped into the role of the bank. And let's be honest, banks don't freak out when the market drops. They just keep collecting payments. Your stock and funds, those are your flexible friends. You can tap them when you need to rebalance or jump on a new opportunity. And then there are your defensive plays, your cash, your T-bills, your safe havens. They may not be exciting, but they're there to keep you calm where everything else feels chaotic. Here's where the magic happens. It's not any one investment that makes you strong. It's how they all work together. When one stream slows, the others pick up the slack. When one market stumbles, another one steps in. And before you know it, you've built something that doesn't just survive the storms, it weathers them with confidence. That's when you stop reacting out of fear and start responding with intention. That's the shift from fragile to flexible, from anxious to assured. And that's what true diversification really is. Let's put some real color on this. Picture two investors. Both start with the same amount of money. Both are smart, driven, and ready to build something meaningful. But the way they approach it, that's where everything changes. Investor A decides to go all in on real estate. They've read the books, followed the gurus, and everything keeps saying real estate is the best way to build wealth. So they go for it. Multiple rental properties, all financed through mortgages, and for a while, life is good. Cash flow looks solid. Property values are climbing. They're feeling confident, maybe even a little unstoppable. But then the market shifts. Interest rates rise. Those easy refinance deals disappear. A couple of tenants move out and one of the properties suddenly needs a new roof. Maintenance costs start creeping in. Property taxes go up. And that once passive income starts feeling anything but passive. It's not that they did not anything wrong. They just build everything on one pillar. And when that pillar starts to wobble, the whole structure shakes a little. Now investor B takes a different route. They still believe in real estate. They buy a few rentals too. But they don't just stop there. They add performing notes to their mix, which start paying them right away. Every single month like clockwork. No tenants, no repairs, no midnight phone calls about broken toilets or something else. Just steady, predictable cash flow. They also keep a small portfolio of dividend stocks. Nothing fancy, just as solid companies quietly send money their way every quarter. And they make sure to keep some liquidity on hand. So when opportunities pops up, a discounted note, short-term private lending deal, they're ready. Then when the market turns, things look very different. Rates rise, property values dip. The same headlines that sent investor A into a panic barely faze investor B, because their income doesn't depend on just one thing. Their notes keep paying. Their dividend still shows up. Their rentals might be slower for a bit, but it doesn't knock them off balance. They can take their time, make decisions calmly, even take advantage of the dip while others are rushing for the exits. That's what diversification really gives you. Breathing room. You don't have to react out of fear. You don't have to sell in a hurry or stress over every headline. You've got space to think, to plan, to move intentionally. And here's the funny part. That's exactly what banks do. They lend money, they own some real estate, they invest in securities, they hold reserves. They don't rely on one stream of income. And that's why they always seem to land on their feet, no matter what's happening out there. The difference is you can do the same thing, just on your own scale. You don't need billions of dollars or boardrooms full of analysts. You just need the mindset, the structure, the willingness to think like a bank instead of a borrower. Because real financial strength isn't about how much you own. It's about how well your money works together. And when you build it right, you don't just survive market shifts. You stay calm through them. You stay confident. You stay in control. If this idea of building stability through diversification is clicking with you, especially the part about creating steady monthly cash flow through notes, you'll want to dive deeper. You can learn more at our website www.ritselnotes.com. That's where you'll find practical, real-world insights on how to balance real estate, notes, and other asset classes. So you're not just guessing, you're growing with intention. Because here's the truth. Wealth isn't built by chasing trends. It's built by creating a portfolio that keeps working even when you're not. When your money is diversified, working across real estate, notes, and beyond, you stop stressing about market swings and start focusing on what really matters: freedom, time, and peace of mind. Real freedom doesn't come from luck. It comes from options, and diversification is what gives you those options. As always, remember, stay focused and go and live your dream.